Alrighty, folks, it is with great pleasure I allow give access to the school community today to actually ask Mr. Dan Bird some questions. If you have questions about stocks, ETFs, commodities, Bitcoin, whatever it is, do me a favor and raise your hand. You can do that by just going to the reaction button and raise your hand, or you can put your stock symbols, your questions in the comments or chat box, and I will get to them in the order they are received. I'll give you some time to do that because Dan and I need to riff about last week. Dan, the Fed came out and, according to Danielle DiMartino Booth, surprised Wall Street. And according to her, he pulled a Paul Volcker, i.e., the Fed had not gone against the market expectations since Paul Volcker. The market had expected a quarter, and obviously, Powell gave a 50. So what do you think of a 50? What do you think of this recalibration? Where do we go from here?
So first off, let me share first, because I do have some things to say about this topic.
Shocking.
So this is my website, breakpointtrading.net. If you're interested, the weekly newsletter is right here in this box, which I published yesterday and actually talked about this specific topic in the newsletter. And I'm going to show you what I put in there. Let's see here. So it's interesting that people are saying that everyone's shocked. Since 1990, six of 10 first cuts were 50 basis points. So
interesting.
So why would it be that shocking?
Let's see that. 22.
So here's one here, 2020, one down. So I'm just highlighting the first ones, the first cuts. Right?
I see it. Yep.
Great Recession, 50. Housing market crash, 50. I also highlighted the ones that are secular bulls and secular bears.
Right.
So the secular bulls are in green.
Got it. That makes sense.
So we got the 2002, which actually was, it was after the dot-com crash, but the market was getting ready to start to recover. They still went 50, first cut. Dot-com bust went 50, and then that was it. But
it's actually interesting. It's interesting you bring this up because I read multiple research reports and I can now see why it's different. There had only been 2 previous times that the Fed had started with the 50. Now, I think based on your chart says 6. I think the difference is a couple of yours were in their chart, they would consider those continuations.
So they probably would consider these right here continuations.
Right. That's what they would do. Yeah.
But there's a gap from October to March.
No. I think you're absolutely. I think what you've done is awesome. I'm just saying, I'm trying to internalize what I've read multiple times with what I'm seeing here, and I think they would term these as continuations.
Yeah, they could, and it's all it's all an interpretation of the data.
Of course. Right? No, I like this. But actually, what I'm talking about is market expectations.
Yes, right.
The market, I think, heading into Wednesday was 63, 66% odds of 25, and whatever's left of 50. According to Danielle, again, I have not validated this, but I'll trust her. She says that the Fed had not gone against the market since Paul Volcker. And what she says is there has always been this implicit Greenspan notion that if the market was ever 78% or greater, that's what the Fed would do. Obviously, 66.
But it wasn't.
I'm agreeing with you. That's what I'm saying. This is what surprised the market.
Right. Yeah, I wasn't that surprised. I kind of thought they would do 25, but I wasn't surprised with 50.
Yeah. So what do you think? What do you think 50 meant? Because I think that's the big question. Is 50? I actually put out videos right around this. I think we talked about this last week. I said 25, the Fed's concerned. 50, they're afraid. They gave us 50.
Right.
So now I ask you, what are they afraid of?
Or are they afraid?
Okay. Are they afraid?
So a couple of things, and we talked about this last week too, but if we look at CPI, I think they see a couple of things happening. I think they see this coming. So CPI headline, this is the 12-month window.
Right.
So there's the one that was just reported in September.
Yep.
The forecast was 2.6, came in at 2.5. So it went from 2.9 to 2.5.
Yeah.
And then we got a big one coming in October.
Mm-hmm.
So this 2.5 is going to go down to 2.2.
Yeah, 2.3, 2.2. Okay.
Right. And then we got a couple of smaller ones, but it'll either be flat or might go down even one more point.
Mm.
So we'll be close to 2. And then we've got through this period here, we got these big, huge ones.
Yeah, and I think this is what Chris Waller was saying. Chris Waller was talking about the Fed has a lot of room to move rates in the next 6 to 12 months. I do think it's this chart that they're looking at. And again, Chris Waller actually said if you annualize PCE for the last 4 months, you already have inflation below 2%. It's 1.8.
Right.
So do you think the Fed is afraid of deflation? Do you think they're afraid of deflation?
I don't think they are yet, but that is a possibility. You can see we actually had deflation right here.
Mm-hmm.
If you look at the 1 month rate of change for 1 month right here, we actually had deflation.
Mm-hmm.
It was below 0. So I don't think they're afraid of deflation yet.
Okay.
But they have certainly conquered inflation, which I said 6 months ago that in September they would declare victory over inflation.
Yeah,
and that I think is what that 50 basis point cut is more than anything.
Okay,
is
I agree with
declaring victory. The other interesting thing, so two of the 3 recession components have now occurred. The Fed cut rates.
Yep.
Usually the first cut, a recession comes about 6 months later.
Okay.
All right. Except for a couple of times in the 90s that did not happen.
Correct.
But the 90s was a raging secular bull market, which, by the way, we are in a raging secular bull market right now, too.
Mm-hmm. True.
Right. The second one is the uninversion of the rate curve. So
yeah, there it is.
The yield curve has now uninverted.
Is that the 2 and 10s or is that the 90 and 10? Oh, 2 and 10. I see it.
This is the 2 and 10s. Yeah. The 2-year minus the 3-month is down here.
Okay.
But yes, this is now uninverted. So it was inverted for more than 2 years.
That's wild.
Right. And now it has uninverted.
Mm-hmm.
So whenever the yield curve uninverts, about 6 months later, there's a recession.
Mm.
So after the first rate cut, 6 months is a recession. After the uninversion, 6 months later, there's a recession. The third one is the unemployment rate.
Mm-hmm.
And when the unemployment rate spikes, then about 4 to 6 months later, there's a recession. So that's 3 things. 2 of the 3 have happened.
Right. What number do you think would indicate that third unemployment? Is it 4.5? What do you think?
I think it's 4.5. So right here, this red line is 4.5.
Okay.
That's basically normal.
Okay.
You can follow it back 35 years. And this green and red line right here is the unemployment rate.
Got it.
The moving averages of the unemployment rate. So you can see 4.5 is basically normal. We were ridiculously, it's low inflation through this whole period, and we went right back to it again after COVID. Lower than historical lows in the unemployment rate through here. So 4.5 is normal. Now, a lot of people that haven't lived all the way back here through 2001 and 1990 might think 4.5 is high for the unemployment rate, but it's not. It's normal.
Yeah, I mean, when I got my degree, it was assumed that full employment was 6.
Right.
Now, yeah, I am that old, but yes. And then I think more recently was 5% was full employment.
Right. So the interesting thing about this is, first off, look at the rate of change down here. Even though this is creeping up right here, it's not at 4.5 yet. The rate of change was starting to creep up too, but now it's sort of reversed. But here's a really interesting part. Let's look at the claims, unemployment claims.
It's funny you bring this up. I just want to ask you a question before you go here. I was at a session last weekend, and I tried to give people 5 economic numbers to look at. Again, try to be a closet economist. And the number one thing I said to look at was weekly unemployment claims.
Right.
Of all the things you could look at, of all the hundreds of economic metrics, if I was just trying to figure out what's going on in our economy, Thursday, 5:30 a.m., weekly unemployment claims. That would be the number one thing.
And there it is. So
It went down.
This is right. No, it went down dramatically.
Yeah.
So this is right on my website. This is the charts page on the website. And right up here in the top left, this little box, recession watch. These are those three components that we just talked about.
Yeah.
But look at claims. Look what they've done the last 6 weeks.
Yeah, 218, I think, this most recent week. Yeah.
If it's green, that means it went down from the previous week.
Got it. Okay.
All right. If it's red, it means it went up from the previous week. But even the red ones didn't go up from the previous week that much.
Right.
But you've got 5 green ones and 2 red ones since this big spike back here. So unemployment claims are continuing to go down. So we had an unemployment rate that dropped from 4.3 to 4.2. I think we're going to 4.1 on the next one.
Interesting. Okay. I mean,
so there's only 2 more of these before the next.
That's true. Yeah.
Jobs number.
First week of October will be here soon.
Right. So there'll be one next week, and then there'll be one just before the jobs number.
Yeah, the jobs numbers come out on Fridays. Unemployment claims are Thursdays. Okay.
Right. So if this keeps going down like this,
yeah,
even if it starts to go up, but doesn't take out these highs over here, right there, we're going to get another lower reading on the unemployment rate. So, and I think the Fed knows that too. I think the Fed sees that as well. So yeah, they're going a half to just to get a head start on it.
Right.
But the other thing too that I meant to mention is that the next Fed meeting is not until November.
Yeah, it's the day after the election. Yeah.
So they won't do one in October. They can't. They don't have a meeting.
Correct.
In October.
Well, they could, but they won't. But yes.
Yeah, they could. Yeah, but they probably won't.
Right. Correct.
So it's not till October. So you really could look at that 50 as 225s.
Yeah, somebody else was saying they should have cut in July, and this was the makeup, all of that. Again, I think it's a sign the Fed's concerned. But according to Waller, if he sees, they're definitely claiming victory on inflation. Right? Waller put it out the other day. It's sub 2%, 1.8, and frankly, in Waller's speech, he made it sound like the risk is to the downside. Waller was saying that rent, owner's equivalent rent or shelter, he expects to fall precipitously the next 5 months. Right? I've been waiting a long time for that to roll over. Waller's saying it thinks it happens in the next 5 months. So that will also take inflation lower.
Yeah, you take that in conjunction with these 4
exactly
12-month windows that drop off. Anytime
you could have deflation. You could have deflation.
you could have deflation. I mean, I don't think we're going to have deflation, but we could be heading for it pretty fast.
Well, you could have a couple of months. You could have a month-on-month deflation like you did below.
You could definitely have a 1 month rate of change could be deflationary down here. I don't think the year over year will be deflationary.
No.
Yeah. But the rate of change, the drop in CPI is going to be dramatic.
All right. So the other thing I want to talk to you about, because one of the things that I'm looking at is lower rates and clearly more rate cuts coming, is it's going to get cheaper to borrow. And when I look at the stock market, we've been infatuated with the Magnificent Seven, who have endless amounts of capital, don't need to borrow, frankly. And if they do borrow, it's at 0 or some stupid rate. But now as rates come down, doesn't that help the Russell 2000, who maybe has more variable rate debt, maybe harder to go to banks? Could we see cheaper lending mean more capital improvements, more investing? Could something like that happen with lower rates?
Absolutely. If we look at growth versus value. So if this line is going down or trending down, that means value is outperforming growth.
And in this case, value is The Russell
Value,
2000 versus the Big Seven.
not necessarily. It's not growth stocks. It's value like utilities and
Got it.
staples,
Got it. Got it. Got it. Got it.
right?
Okay, got it.
We'll
Got it.
we'll look at the other one in a second. But here's large cap, small cap, and mid cap growth versus value. So growth is sort of waning. You know, the Qs are the Russell. These all start at the beginning of the year. They all
Yeah,
start at zero.
is zero.
So,
Right. Right. Right.
so they're relative to each other. So Russell is still underperforming the Qs, but it's catching up.
Yeah, the gap is closing.
Right. These are performance charts. It's kind of a spaghetti chart, but the red line right here
Mhm.
is where the peak was in all of these things. So this is the blue is growth versus value, the Qs versus the S&P, transports versus industrials is the orange, discretionary versus staples is the green, and the Russell versus the NASDAQ is the purple. So the Russell is still underperforming the NASDAQ right now because this is going down, but it's not going down as dramatically as some of these other ones. This is even as the S&P goes higher. So that is a negative divergence. So as the S&P goes higher, these are going lower. And if I look at the rotation chart right here, this shows it pretty clearly. So here's the S&P up here. It's moving higher. This box is kind of identifying where this low was back in August. And as the S&P has gone higher, you can see what's happened with discretionary versus staples, NASDAQ versus the S&P, technology versus the S&P, growth versus value. They're all going down. So that's rotation. So Wall Street is rotating out of aggressive sectors and into defensive sectors.
That rotation doesn't necessarily mean the index falls.
Right.
In fact, might mean the index goes up, or it's just broadening out. Is that how, as an amateur, to read
That's right. That's right. As long as that rotation, as long as the money rotating out of growth is the same money that rotates into value, the market's not going to crash. It might go sideways.
But we may have a growth stock take a big haircut.
Yeah, the growth stocks, the Magnificent Seven, could take a haircut. So if I look at Google, for instance, which I think is the best one to really highlight this. There's Google. Google's can't even get above its 50-day moving average.
Interesting. Okay.
So from July right here, Google has just continued to go down. Whereas if I look at something like Constellation Energy, did you see that Friday?
No, I did not.
This is really interesting. Constellation Energy is a utility stock. Utilities are the most defensive areas. So Google, a big tech, should be one of the most aggressive. Utility should be one of the most defensive. Here's Constellation Energy.
Oh my goodness.
Look at that.
Look at that gap. Look at that gap up
22% on Friday.
Sheesh.
Now, do you know why that happened?
No clue.
They announced Friday that they are bringing back up one of the reactors from 3 Mile Island.
Oh, for Amazon or Microsoft or somebody.
For Microsoft, specifically for Microsoft.
For all their AI chips.
For the AI, that's right.
Interesting.
So utility stocks all of a sudden have become the Magnificent Seven.
Yeah, 22% move. That's nothing to sneeze at.
Let's look at NRG. It's another one. NRG, conventional electricity, same as Constellation. So it's breaking out right now.
Interesting. Okay.
This is a South American stock, but it's the same thing, conventional electricity. Look what it's doing.
Yeah.
So all that movement from Magnificent Seven into utilities, those are complete opposite ends.
Right.
Technology is at the high end of the aggressive sectors. Utilities is at the high end of the defensive sectors.
Correct.
They're switching. And it's really interesting that some of these utilities, conventional electricity companies, are becoming like technology companies because of AI.
Interesting.
So here's the Russell 2000. And you can see it's really been very choppy. So it's trying to get direction, but hasn't really been able to do that. This is a longer term view. But ever since the beginning of this year, it's been trending higher, but it's doing so in a very choppy manner.
Yeah.
But it is trending higher. So I think there's still time,
Right,
for the small and mid caps. I don't think they've played it
well, I
out
think it's
yet.
I think it's a long-term trend, right? Because I think the Fed
Yeah.
has made it clear that borrowing rates are going down. The Russell
Mhm.
2000 is disproportionately affected by lower rates because they have variable versus fixed rate debt. If you look at their
Right.
balance sheets,
Yep.
it makes perfect sense. The other thing I'd love to look at, I know you have a chart on, is the 10-year note. Again,
Yes.
I'd love to look at the 10-year because again, I don't think a lot of people realized that mortgage rates went up after the Fed cut 50, which I think shocked a lot of people, but frankly was predictable because of the big collapse we saw going into it, which is now on screen.
Right. So there's the 10-year right here. It had a little bump last week,
Yep.
even after the Fed
Yeah,
cut.
mainly after Wednesday.
But it's still in its downtrend channel.
Okay.
And by the way, you can see bonds right above it. And bonds actually did the opposite. So you would think that bonds would have got a bump higher also with rate cuts, but bonds actually came down too.
Yeah.
So
It's
the 10-year
interesting.
went up, which
Yeah.
is typically what they do. They're
Inverse. Yeah.
mirror images, yeah, inverse of each other.
Yeah. What's going to be really interesting is the market is already anticipating another 50 basis point cut in November and frankly 75 by the end of the year. So 50 and a 25. It'll be interesting to see when the 10-year or if the 10-year starts to represent that, because I think if you look at that chart above, the 10-year note told you a big cut was coming. As it dropped
Mm-hmm.
from, 4.2 to, 3.6 pretty quickly.
Yeah, right through here. I mean, all the way back here in June. That's when it started dropping.
Yeah.
And the TLT, this is the 20-year bonds. It started going up right here at the end of July, significantly.
Yep.
Now it's pulled back again now, but I think it's definitely going to go higher next year. If we look at the 20-year bonds right here on a daily chart, you can see again, it is definitely trending higher. This is a 5-year chart.
Yeah.
4-year chart. So it is definitely trending higher, and I think this one will continue to go higher.
Well,
As
yeah. I
rates,
mean, if rates go down, bonds go up.
right.
Yeah. It's going to be interesting. Well,
Exactly.
we do have,
At least in the beginning, at least until rates stabilize,
right.
then bonds should go up as rates come down. Now the dichotomy here is that the market should also go up into the end of the year. So normally you've got bonds going up and stocks going down. We've got a tough period now starting next week. Next week is the worst week in the worst month of the year for stocks.
Oh, joy. The worst week of the worst month. That sounds like fun.
Yeah, worst week of the worst month, the week after options expiration.
Okay.
But starting in October, then we've got the best period of the whole year for stocks going into the end of the year. And usually after the election, regardless of who wins, the market usually goes higher after the election. So you've got bonds that could go higher because rates are coming down, and you've got stocks that could go higher. So what do? You do half and half. Now I think bonds are going to definitely go higher into next year, and we've only had the first rate cut.
Right.
So there are clearly more coming. So as more rate cuts occur, you can look at the relative performance of a variety of bonds here. And you can see the 20-year here went down, even as corporate bonds went up, high yield corporate and junk bonds went up. This is the short, this is the other side. So if junk bonds are going up, this one should go down, which it is. But all these bonds, except for the 20-year, is the only one that went down last week. So I think that'll turn around. And we've got in October, we're not going to have any more rate cuts.
Nope, no Fed meeting.
And October is when the rally into the end of the year will probably start with stocks. So you might have the best of both worlds. You might have bonds starting to do better and stocks doing better into the end of the year. And then as more rate cuts come, bonds continue to do better. So maybe then rotate out of stocks at the end of the year and into bonds for next year.
Right. Well, I'll ask you about a recession here in a minute, but I do want to get the audience involved. We did get one question, one stock to look at. Again, folks, you can put in the chat stock symbols. Our first one is Amazon. Joe asked about
Okay,
Amazon. Can you pull up Amazon for us?
sure. So Amazon is one of my Magnificent Seven, and I created these trend models for indexes, sectors, and Magnificent Seven plus some other ones. And what this does is it shows the short-term, medium-term, and long-term trend. And whenever that changes, I update it here. So anything that's highlighted means it changed last week. So Amazon here had a medium term. It was a bearish signal on September 17th that flipped to a bullish signal. So Amazon right now has 3 green arrows. You can see the long term was all the way back in May of 23. So if I look at the Amazon chart right here, we can see right here where it crossed over, where the 5 crossed the 21, or the pink crossed the blue right there. That was the short-term signal. Here's the medium-term signal right there that happened last week. It still has not got back to its high, which is back here. But if I look at it on a longer-term weekly chart, I can see that it has been in a nice uptrend all the way since June of last year. It had a pullback right above the 200-day moving average. And this here is called a cloud. I'm not going to go into how this is created, but basically think of it as identifying the long-term trend and where support and resistance is. So you can see Amazon came right down to the top of that. That's where support was, and it bounced. It's going back up and had a nice green bar the last 2 weeks. This is a weekly chart. So Amazon looks really good. It needs to take out its previous high over here, but it looks like it's probably going to do that. And all the momentum indicators are turning up as well.
Very cool. Well, let's get somebody who was brave enough to raise their hand. Lars, you're out there. Please unmute yourself and ask your question.
Yes. Here's my question. If by lowering rates that Powell inadvertently became Arthur Burns, how would that affect the market? And Zuber, I guess a follow on there, at what point would we know or not know if he did? There's my question for both of you.
Yeah, so let's break this down a little bit. Lars, that's a wonderful question. You know, if you hear my daily financial news, that is a real concern of mine. I'm very concerned about repeating 1981-82 recession, which was nasty, deep, dark, personally hurt my family a lot. We almost lost our family home, which is horrible as a 10-year-old. I guess I'll go to you first, Dan. Arthur, as you know, Arthur Burns was the Fed president pre-Volcker. He cut rates because he declared victory early and started the second inflation bout. What would be something you would see in the charts that makes you think inflation's taken off again, Dan?
Yeah, that's a good question. We can go back to, this is probably the best one to look at. You can just look at this every month when the CPI number comes out. And we just looked at it. So what would concern me is if you see these real narrow ones right here. When we hit those, which we're going to hit in the November report and a little bit in the December report. So the last 2 CPIs at the end of this year, it's going to look like, well, the next one is going to look like inflation is going down more.
Yeah, no question.
So there's a big gap right there. So it's going to show again, right now it's at 2.5. I wouldn't be surprised to see it go to 2.3, maybe even 2.2. But the next 2 are small ones. So it actually could start going back up.
It could.
So we could get back to 2.3 and maybe 2.4. And everybody's going to say, oh, yeah, he is Arthur Burns. See, inflation's coming back again.
I actually think, Dan, it's actually higher on that chart. I think the risk of inflation repeating starts in April, right there. Those 5 months, that could be a problem.
Yeah, over here, yes.
Correct.
Yeah, these over here, yeah, because these are actually negative.
Yeah, that's the rub. So what I would tell people
but
look at.
Look at these big ones before we get there. Look at these huge ones before we get there.
No.
I mean, we could be a 1.5 before we get here.
No, we could. But then we can go to 1.7, 1.9, 2.1, right? We could get that reversion. So Lars, I guess there's a couple of things I would look at in the short term. I would look at the commodity complex.
Yeah.
And I would look at copper, Dr. Copper, they call it. It's the most sensitive individual. I would look at copper. Does copper take off? The uneducated economist highlighted lumber for us. I would look at lumber. I would look at the raw materials. And then the other one I would watch out actually is labor. I would because we are a service-based economy. In a service-based economy, the thing that would turbocharge inflation 2.0 is labor. And labor equals wages. If we started seeing unemployment fall, job openings skyrocket, kind of a repeat of a year ago when the JOLTS report was 10 million and the unemployment rate was 3.4, we could start seeing labor numbers at 6.5, 7. That's concerning because all of that labor or wages typically is discretionary. That then feeds back into the supply chain. And that's kind of inflation 2.0 for me. It's a couple of commodities, copper, lumber, but I think the thing I would watch in the short term is labor. That said, if we went back to the other chart, I think we're going to see inflation rise the second half of next year because of the same reason why it's going to fall in the first half.
Yes. So this is June, July, August right here.
Yep.
So this is about a year from now.
Yeah. So we can hear.
So yeah, these will reverse the downward trend of inflation.
Yeah, for 3 or 4 months there, I suspect the headlines will talk about inflation reinvigorated or inflation this or that, but it's kind of baked in the cake when you look at how it's calculated.
Yeah, I mean, you could even look at the commodities right here. There's copper. Copper's trending back up. Oil and gas are still really low, actually. CRB, which are these components over here, agriculture, energy, and metals. It's spiking this month. And then this is the agriculture right here. And it's spiking this month.
Yeah.
So yeah, this piece right here is what could throw a wrench into that CPI number next month.
Yeah.
So we might not get to 2.2. We might stay stable, might stay at 2.5 or maybe 2.4 with a combination of increased commodities along with the base effect right here that's going to cause it to go down.
Yep. Yep. Well, folks, again, remember,
but you know what? On that question, that was a really good question. Mm-hmm. I think for that reason, I don't think Powell is going to go 50 in November.
Oh.
I think he's going to do 225s.
Okay.
So I think he's got plenty of ammunition right now that he could use either way. So I think he'll come down slowly, not rapidly.
Okay.
Unless unemployment, like you say, unless those labor costs really start to spike up. Mm-hmm. And then this is the thing to watch is the claims. Watch the claims number.
Yep.
That's dropping off a cliff right now.
Yeah. It is something to watch. It's obviously, we've all heard this before. History doesn't repeat itself, but it rhymes. I look at the early 80s and freak out. So maybe I'm over-indexed on that. But yeah, it's labor and a couple commodities. If you just want to watch it every month, those are things I would look at. Again, folks, remember, you are a part of school. You pay to be here. Raise your hand.
By the way, talking about the 80s, mm-hmm. This is my go-to chart. It's right on the homepage of my website because it's so important. These are the secular bull and bear markets. Yep. My charting program only lets me do this back in 1990. But we are currently in a secular bull market. We are right at the top of it right now, by the way. So this indicator up here is actually in overbought territory, but it can stay there for quite a while, as you can see. This one here has not gone back to the peak, but it's close to this one. This one is actually at the trend line, the upper trend line. So we are due for a pullback. It would actually be healthy if we had a pullback. I'm not sure it will happen in the end of this year, but it could certainly happen next year. Right here is 2022. That's a cyclical bear market right there. It never went below the 200 week. Even COVID, even though it went below it, it never closed below it. These all stayed above the 200 during the secular bull market. Secular bulls typically last 18 to 20 years, which means this bull should go to 2029 to 2033, somewhere in that neighborhood, right? And then the secular bear is back here, usually lasts for 12 years. This is from the dot-com crash through the financial crisis, and then we finally broke out here in 2013. But if we go back even further, we can look at the 80s, and 81 was actually what started that bull market. This bull market right here.
Wow, look at that.
So there's that pullback right there in 81, 82 that you were referred to.
Yep.
But once that completed, we were in another secular bull market, which lasted 20 years. That's what we're in right now. So any recession we have will be short and shallow. Any pullback we have, like we did in 22, will be a cyclical bear market. So it's not going to last that long. Recession won't last that long. We're still in a secular bull market.
Very, very cool. Well, again, folks, remember, you pay to be a part of school. So raise your hand, put your question there. All right, let's see. We got a question for someone. With the Fed now beginning their rate cutting cycle, where do you choose to keep your dry powder? Just in cash, bonds, money market funds, to name a few. Where are you keeping your dry powder, Mr. Bird?
So I am a trader.
Right. That's
so
a good caveat.
My money goes into money markets in my account. When I buy a stock, make a profit, sell the stock, it goes into a money market. But if I were an investor, or let's say more of a trend trader, or not long-term buy and hold type of person, but somebody that would want to stay in for a year or so. And what I would do right now is I would wait. I would not be adding any positions right now. I would be waiting for the October timeframe. Middle of October is usually the low point of the year, and the end of the year, the last week of October till middle of January is the best period of the year for stocks. Historically, right. That doesn't mean it's going to happen every year, but yes, historically, that's the best period. So I would be planning my entries. I would be doing my research right now. I wouldn't be taking any new positions. I'd be doing my research and identifying good stocks. And then in that period, I would probably be adding. But if the market does roll over next year, say in January, and we go into a cyclical bear market, like we did in 22, which lasted from January till October, then I probably would move to a money market, or actually right this year, this time, bonds, I think would be a really good place to be. Yeah. In fact, I'm moving my money, my mother's money. Right now, it's mostly in stocks. I'm moving at 50-50 bonds and stocks. And probably after we get to January, move it all in bonds. So that's what I would do. And it really depends on your time horizon, depends on your, what kind of trader or investor you are, how long you want to be invested, that type of thing. So I can't really give you a specific answer because I don't know everybody's style.
Yeah. I can tell you where I keep mine. Again, I'm a real estate guy, so most of mine's in a money. Yeah, right. Most of mine is in a money market account. I do have some high interest CDs, very short term. We're talking months, 90 days. But yeah, it's basically how soon do you expect to deploy their money.
Right.
I do have a little bit in high yield savings.
This is Bitcoin, by the way.
Oh yeah, let's look at Bitcoin. Go for it.
So Bitcoin is just kind of going sideways. It's getting back up to its 50-day moving average, or 200-day moving average right there.
Oh, bounced off it, looks like.
Yeah, bounced off it. Might get rejected. We'll see. But it's really just gone sideways ever since the halving event back here in April. Hasn't really moved much. Up a little, down a little, up, down, up, down.
Yeah. Very
trending down, though. I mean, the overall trend is down.
Yeah. We do got one more question here from Lars. Lars, go ahead and unmute yourself. Ask your question.
Yes. Another question I have is, I understand none of us have a crystal ball, but do you think there's a greater than 50% chance that that the Fed funds rates drop by 2%, or that inflation gets reinvigorated and and puts that good shock in the market in the middle of next year?
So I want to make sure I understood the first part of your question. When you say drop by 2%, do you mean drop by 200 basis points, or do you mean the
Yes.
Fed funds is 2%?
No. It drops 200 basis points. So is there a greater chance they keep on this trajectory, or or in the middle of next year with those high inflation ratings, that there's a surprise there waiting for everybody that nobody saw, until you get like a month out or something like that?
I'll go first. Dan, let you play with that as well. I think the Fed is rather committed to cutting at least 200 basis points, right? They've already done 50, so that means 6 more cuts. I think there's a good chance they get 150 between now and June. So I would give that 75% chance it happens, 25% chance it doesn't. But then we're in June to that CPI chart. And I do think CPI goes up just given what's called the base effect. And I think the Fed will pause because they don't want to cut into that. I do not expect it to. I don't think CPI goes above, I don't know, 4, for example. I don't think it even goes above 3.5. But the fact that CPI could go up 3 months in a row by 1/10 will cause the Fed to pause through the summer. That's my current wild ass guess.
Yeah, I would agree with that. And I'm not sure if you meant 2 basis points from here or 2 basis points total.
I read it as total.
200 basis points.
Right.
But if it's 200 from here.
Ooh, that's different.
Right? That's different. But if it's 200 total, then another 150, I think for sure. I think they'll have, 50 of that by the end of this year.
Yeah.
So they'll be down by 1% by the end of this year at least. And then I think they will continue to cut probably 25 each month.
Yeah. Yeah, I think 200 is the number.
And I agree. I think this is going to show it dropping dramatically through this period, February to May.
Yep.
So let's say we had 50 there. Let's say we get 25 and 25, taking us to December.
Yep.
Right. And then we get 25, 25, 25.
Yep. 25. That's 200.
25 there. There's 200 right there. Yes, absolutely. We could get down 200.
And then I think they pause.
Yeah, and then they'll probably pause. I mean, they see this too. This isn't unique to us. They can look at the chart as well. So they know that this is coming. It's not going to be a big surprise. It shouldn't be a surprise to anybody when inflation goes up again.
And to Lars, I think the bigger point that now I'm getting more comfortable with, if the Fed wants to do all their cutting before the summer.
Yeah.
Right. They don't want to cut in this picture in April, May, and June. Right. Because CPI will technically go up. They want to cut when they have tailwind. But then I think they're done cutting, I don't know, by the March, April meeting. So it'll be rather front loaded, I think.
Yeah. Yeah, I agree. I think they will continue to cut every meeting. I don't think it's going to be 50 though. I think it's going to be continually 25 basis points.
We'll take that bet. I think a 50 is coming in November.
Okay. We'll see.
Yeah.
I think they did the 50 because they don't have a meeting in October.
Yeah.
So they basically did 2 25s, and they're going to continue to do 25 all the way through this next summer, just like you said.
Could be. Yeah.
But they know that this is coming. They know that that CPI will get a bump. They know that it's going to look like inflation's coming back again. Everybody knows that. That is not a big surprise. Through this period right here, it's going to look like inflation's coming back again. Just depends on what the rate of change of that inflation will be. Mm-hmm. Is it coming back dramatically, or is it coming back, slowly, a little bit at a time? But everybody knows it's coming, so it's not a big surprise. The other big question, interesting question, is will there be a recession next year?
Yeah, I was going to ask you that next. What do you think?
All of the historical indicators say yes, except for, the unemployment rate. We haven't hit that one yet.
Mhm.
But I'm thinking it might be more like the mid 90s. Where
And by
we,
the night, like 94, where the Immaculate Conception, where you had a soft landing.
yeah, in a
Yeah,
soft landing.
yeah, I'm still convinced, frankly, we are in a rolling recession. I think we're actually in it. And the reason I say that is I'm a housing guy, right? So the mortgage industry, depression, real estate industry, depression. But now we're in a rate cutting cycle. So we're going to start to see real estate add positively to the GDP. I've already
Yes,
told you a refi boom is coming. Nailed it. I think we're going to get more sales, more home building because rates are coming in, construction, all of that. So
right.
I think the economists are confused. We have never seen a run up in the M2 money supply like we saw in the 5-year period. I think the money is sloshing around in the system. And I think it's going to take another year, but I think they're going to call this a rolling recession.
Yeah, I agree with that. And I actually talked about that yesterday. I did a Zoom call with all of my subscribers where everybody we spent 2.5 hours just talking about different stuff.
Yeah.
And we talked about the rolling recession and what that really means. So what that means for a stock investor, trader, is you look at sectors that are out of favor as that rolling recession moves along.
Yep.
Right. So industrials and real estate was out of favor for a while, and now they're coming back.
Yep.
Technology was doing great, and now it's declining. So you want to look at the ones that were doing bad because they're the ones that are going to come back sooner.
Yep.
I
Yeah,
just
that's
talked about
exactly right.
utilities, how utilities is all of a sudden becoming the technology group. Utilities is the most defensive area. Well, they're now coming back as technology is going down. So
Yeah.
talking about M2, by the way, and then we'll get to that stock symbol.
Yep. Thanks.
Here's the M2 chart, which caused a big stir a couple of months ago when it went down by 5%, and lots of articles saying that hasn't happened since the Great Depression.
Great Depression. Great Depression.
M2 hasn't come down by 5% since the Great Depression. Well,
Yeah.
we
Zoom out,
also
people.
we also haven't had a 100-year pandemic since the Great Depression.
Yeah.
Right. So here's the trend. This pink line right here is the normal M2 trend. So we need to come down another 12.5. It's actually more than that because the M2 has actually gone back up now. We need to come down like 13% more just to be on trend, just to be normal. So put anything you see, put it in perspective. Put it in perspective with a 100-year pandemic, because that has changed everything.
Yeah, and I think that's going to be the whole reason it goes, because the rolling recession will go down as something that could last 24 months, that it'll be really shallow and frankly may never go negative, just be below trend growth.
Yes, that's right. By the way, if we look at PE ratios, PE ratios are very elevated right now.
Yeah.
So this is 25. This red line right here is 25. Right now we're almost 30.
Jeez.
PE ratio is almost 30. Here's the S&P weekly chart, and this is the VIX right here, which crossed positive. And here's earnings. So earnings still look pretty good, and we've got earnings starting in a couple more weeks. But if you look back to 2022, you can see earnings came down, then they started going up, but they never got back to the peak over here, even though the PE ratio was actually above peak.
Yeah, it'll be interesting if that reverses, given that borrowing costs are going down, and that could impact earnings a lot. So let's do some stocks. We got a stock, DEO.
Diageo. So this looks like an ADR, looks like a foreign company. And the reason I say that is this is a chart that I call gap happy. See all the gaps?
Oh, wow.
Look at this Thursday. Gapped up, then it gapped down. Gaps all over the place. Hard to trade one like this, but in general, it's trending up, trending higher. If I look at a long-term view, it actually is below the trend. So it's trying to recover, and it looks like it's doing a fairly good job of recovering, but it has a lot of work to do. It's got to get through the 50 right here. It's got to get through this cloud. That's basically the long-term trend. Long-term trend is down. It's got to get through the 200 way up here.
Yeah.
So it has a lot of work to do to try to get through all of that. And it's starting to get there. But this is one that I'd be a little wary of. I mean, I don't know what your position is, Lars, on this one. I don't know if it's when you're in or you're thinking about getting in or wondering. 9 of the top 10 liquor brands in the world. Yeah.
Oh,
So
there you go.
if the market tanks, it should be a good one.
Yeah, that's right. A lot more people drink.
Right. But if it's one that you own, and I don't know where your entry was, but I think it looks like it's making a recovery. I'm a big believer in putting stops on anything that you buy. I would, in this particular case, I would put a stop right down here at the 50-day moving average, which is at about 125. So I would let it go up if it's going to go up, but I would be out at 125. That's just me. And I have a different time horizon, different trading style and everything else. So I can't really make a decision for you, but just looking at the chart, that's what the chart tells me, that looks like where it's trying to recover from. And if it comes back down and takes that out, then that means the uptrend is over.
Right.
So this is a higher low. That's the definition of an uptrend. This is a higher high. If it takes this low out, then it's now forming a lower low, which is now the definition of a downtrend. So that's why I would put the stop there. And if it goes below that, I'd be out.
You're out. Very cool. Well, why don't we also look at Palantir? Palantir's made some massive moves. Jim Cramer basically said it's a meme stock now, so I thought that was really fun. I guess that means the stock's going up.
Not if Jim Cramer said so. It's going to go down.
No, Jim Cramer called it a meme stock, so he says it's going down, so that's why it's going up.
Oh, I got you. So it'll go up.
Inverse Cramer.
So Palantir is on my list of Magnificent Seven because it is an AI stock.
Mm-hmm.
Oracle is on here too, by the way. Oracle has been doing great. So Palantir looks excellent. This is exactly what you want to see in a stock. You want to see it staying above its 50-day moving average. It's right there. 50-day is where Wall Street likes to add to their positions. So right here, it is where it hit its downtrend in May, started an uptrend, came down. Wall Street added, went up, came down to the 21-day, almost the 50. Wall Street added, now it's up here. I wouldn't be adding any more right here. But if it does come back down again, I would probably add more down here. And if we look at this on a long-term basis, it's definitely above its trend. You can see how well behaved it is. So this is not what a meme stock looks like. If you want to see what a meme stock looks like,
those were not my words. I was repeating Jim Cramer.
I understand, but if you want to see what GameStop looks like in comparison, there's a meme stock.
Yeah.
This big huge spike after it's been below the trend, huge spike, and then all the way back down to the trend again.
Yeah, all because one guy posted a meme where he leaned forward in his chair.
Yeah,
exactly. That was that day.
That's not what this looks like. This looks like a very nice, orderly
climb higher. Yeah.
It's near the peak right now. So this is not where I would be adding to it. I would be waiting for a pullback. But I think Palantir in the long run is going to do really well.
Yeah.
It'll probably get bought out actually by somebody.
Yeah. Well, you and I were both in the software game for years, so that's the game that's played there.
Right. Oracle too has been doing really well. Look at that. This is Oracle's earnings right there.
Yeah. Oracle
is a kind of a sleeper in the AI stock because it has a cloud, that competes with AWS and competes with Microsoft.
Yep.
But it's a much more secure cloud. So this is a cloud that's used by major corporations,
government, and all that. Yep.
Yeah, government, enterprises, things like that.
Yeah.
And this is one I would not be at all surprised to see Oracle, Larry Ellison, make an announcement that he's buying an electricity company like Constellation Energy.
Interesting.
That would not surprise me.
Very
He
cool.
already bought a healthcare company.
He did.
Yeah.
Yeah.
So Oracle is one to keep an eye on.
Well, Mr. Bird, we are running up on our hour. We appreciate your hour. Thank you for giving the education. Thank you for taking the members' questions. Show your website one more time, and we will be ready for next week.
Absolutely. And this is the website, breakpointtrading.net. And for my subscribers, I just did this yesterday. I do a Zoom call, just similar to what we're doing now, except there were 40 or 50 people on, and we talked about all kinds of stuff. We spent two and a half hours, and we could have gone longer. And there's the recording from yesterday.
Oh, good for
right
you.
there. So I put all the recordings from the previous ones right on the website.
Awesome. We appreciate you, buddy. Take care of yourself.
All right. Have a good one.
Later. Bye, everyone.